Thank you. Well, firstly, hats off to Avner and Jim for keeping this conference marching from strength to strength for, almost 3.5 decades now. That's a remarkable run. So, as you saw from Dominik's presentation, he is an enormous amount of material that he has in his paper to build his case. Many, many figures, something like 20 figures, many of them have sub-figures, 16 tables, that's just in the main part of the paper. I'm going to focus on what I see as the main high-level takeaways in the paper. Let me preface my comments by saying, I found this a very thought-provoking paper. As a discussant, sometimes I think, the highest praise I can offer for a paper is, this paper made me think, and this paper made me think. The main idea I see in the paper is low interest rates lead to a fall in the supply of business loans, that leads to a fall in business investment, that affects business creation. And the connection is through the fact that when interest rates are low, there's a shift of households from time deposits to demand deposits, and banks are somehow matching up time deposits with business loans. So I'm going to stipulate to two facts right away that I'm taking two figures from the paper. This one actually Dominik had shown. Just let's admit these into evidence right away. I'm going to focus then, once we agree on these facts, well, I'm a little less sure than Dominik on what these facts mean. So this figure is just showing the strong correlation between C&I loans year on year with time deposits year on year. Don't have much to say, just stare at it. It's clearly a strong positive correlation. I think you quoted a correlation of 0.77, and well, we look at the figure, it's a strong correlation. The second figure is the correlation between the change in the Fed funds rate and the year-on-year change in time deposits. And again, you look at these two lines and you say, yep, clearly a strong positive correlation. We don't have C&I loans plotted here, but just put this together with this figure on the previous slide, and you say, okay, there's clearly a strong connection between the Fed funds rate and C&I loans. The all-important question for me, is the connection between the federal funds rate and business lending, is this a causal relationship or not? Well, we're at this stage and we'll raise three possibilities. One possibility, and this is the one that Dominik forcefully argues for in his paper, is yes, it is a causal relationship. If it is a causal relationship, it raises some incredibly important questions about what optimal monetary policy should be. I'm going to pose some of these questions here. Advance warning, I don't have any of the answers. I'm going to pose these questions. The other possibility, that's B, is look, anytime we think there's a causal connection between X and Y, at the back of our minds we should think, is it possible there's something else, Z, that's driving both X and Y? And here I'll say, well, just the state of the macroeconomy. I'll be a little bit vague about what the Z is, just the state of the macroeconomy. The third C is not a real choice, For those of us looking for an easy exit ramp who don't want to grapple with the question, yeah, throw your hands up and say, maybe. So, is the federal funds rate causally linked to time deposits? This actually I can believe, right? So the statement is the fall in the federal funds rate, it leads to a lower spread between time deposits and demand deposits, and households switch over to demand deposits. Essentially, it's saying, look, rates on time deposits are more sensitive to the federal funds rate than demand deposits, implying, banks have more market power in the demand deposit market. This we can believe, right? Demand deposits offer this convenience, especially for firms. So firms are not likely to substitute away from one bank to the other because of small changes in rates. On the household side, I can put my money into a time deposit. I could put my money into treasuries. So clearly, there's outside competition for time deposits in this market. We can fully believe that rates on time deposits are more sensitive to the federal funds rate than demand deposits. So that one I'll accept. Where I start having a little more trouble is there a causal link between time deposits and C&I loans at firms? So we're going to play Mortal Jeopardy. My slide-making skills are clearly not as good as Mark's. I could not put the jingle on, so just imagine the Jeopardy jingle in your head, right? So the answer is banks fund C&I loans with time deposits, And they fund long-term treasuries and mortgage loans with demand deposits. And the question is, write down the model that makes this rational behavior on the part of the bank. The objective function will be some notion of maximizing value. You get to choose what constraints you want. Clearly, prices have to play an important role here. So one answer might be, what happens is, if a bank has to liquidate a CNI loan, this is really costly. It has to take a big discount on the CNI loan. But of course, as we've seen, there can be large discounts relative to face value. I get in a time deposit of $1, I invest this dollar in either a long-term government bond or mortgage loan. Relative to face value, in states of the world when I have to sell that government bond or the mortgage loan, there can be large discounts to face value. We have seen this, right? So we saw Silicon Valley Bank, which the treasury portfolio had declined a lot in value, or during the financial crisis, we saw when mortgages need to be sold, they were being sold at much less than their face value. So now my question is, why is this bank saying, look, I don't want to take a discount in selling CNI loans, but in states of the world where I have to sell these other assets, I'm perfectly happy to take a discount. Now, to me, is this a behavioral story of some kind? Is the bank sort of not aware of these risks, or does it have some incentive problems here? So the statement is, the bank is making illiquid loans, and it's funding them with illiquid deposits. And then the liquid deposits is putting them into liquid assets. What's that mean? A corollary seems to be, the bank is not engaging in liquidity transformation. All these years, I've been thinking what the bank has been doing. It's mopping up our short-term savings, and it's making a long-term loan to Boeing so that Boeing can bolt down the doors on its planes. Both parts of that statement are being called into question in the last few weeks now, both parts of that statement. So now we've got to rethink what banks are doing. The other corollary is, well, banks don't care that much about duration risk. Time deposits are longer duration, whereas these CNI loans, because they're floating rate loans, are short duration. Banks don't care about duration risk, or not as much as we'd like them to. We have seen this over and over again, right? So we saw this with Lehman Brothers, having these long-term mortgage loans funded with short-term repos. We saw this with Silicon Valley Bank. Can I just say, it's mildly depressing that 40-plus years on since the savings and loan crisis, we haven't figured out a way to get banks to care about this risk. Oh, I'm going to skip the slide about the exogenous shock, since you didn't talk much about it in the presentation. Okay, now I'm going to throw out something. It's going to sound absurd, but I'm going to throw it out for you to think about, okay? Suppose we look at a strict causal interpretation. What this means is, when the Federal Reserve Bank increases the federal funds rate, that's going to lead to more time deposits. It's going to lead to more business lending, which then means more business lending, more business investment, more jobs. Now I'm really confused. Now, does that mean that in 2009-10, we should have told the Fed, hey, you should be raising the federal funds rate if you want to stimulate business lending? Just as a side note, you folks remember those years where we all worried about the zero lower bound and whether we could stimulate the economy anymore once we were at the zero lower bound? Was that all just misplaced because we just had the wrong target for the Fed fund rate in mind? Other option is, of course, say, no, I'm thinking about this completely wrong. What's happening is a reduction in the Fed funds rate does discourage business lending. It does discourage business investment, but overall it's expansionary for the economy. Fine. I can believe that, but then we have to think, okay, if a cut in the Fed funds rate is discouraging business lending and business investment, which is the part of the economy that's being boosted by this cut? The other part of the economy is households. Of course, they interact with business and so in such rich ways. It really becomes somewhat of a vexing question for me. here's my option B, that this is not really a causal relationship. Interest rates, lending, these are all being jointly determined by the macroeconomy. We're seeing equilibrium outcomes, and we're seeing correlations between these variables. So let me revive the conventional wisdom for us here. Interest rates are low when the economy is sort of in down states of the world. That's when interest rates are low. That's when there's low demand for capital. Businesses don't want to invest. They're seeing, future cash flows are low. And this natural rate of interest, this WIC sell-in rate, R star, is low. Just a quick reminder of what this natural rate of interest is. Think of it as the real short-term rate of interest that might prevail when the economy is at full employment and we have no inflation. So this is a figure taken from the New York Fed. This is the Holston Laubach Williams estimates for R star. I have this, it's been a long time now, so I don't remember exactly. I have a vague memory of John Williams TAing one of my macro classes in graduate school. Of course, his much bigger claim to fame is that he's the president of the New York Fed. So policymakers take this rate very seriously. And as you can see, it's hovered between, 2.5 to 3.5 or 2.5 to 4%, until, of course, we had the financial crisis, and it fell steeply at that point and has been lower. The next slide, I have the nominal Fed funds rate, and then the 1 month real interest rate. And the 1 month real interest rate has typically been below R star because the economy often is not at full employment, and the Fed has been trying to keep the short-term rate below R star to try and boost employment. And so the alternative possibility here is the Fed is just following some sort of Taylor rule here. One of the important ingredients to the Taylor rule is this natural rate of interest R star. Whenever we have a decline in economic activity, or we enter down states of the world, like we did with the great financial crisis in 2008 or 9, R star falls. Well, of course, the Fed has to reduce the Fed funds rate at that point of time. And so then this connection between a decline in the Fed funds rate and a decline in business lending is just a correlation driven by some much deeper factors in the macroeconomy and is not causal. Just a couple of other points that I want to make. So one point I want to make, the paper convincingly shows that supply effects are important in determining loan quantities. It's not just demand. Actually, I really like the way Dominik showed that in his paper, and he showed that in his slides as well, which is just think of demand and supply, and if I'm doing this right, so when supply falls, the quantity should go down and the price should go up, and he shows that, and so that I'm convinced by this, consistent with sort of other literature out there as well. He also shows that small business creation falls when time deposits fall. I just want to mention this paper by Greenstone, Maas, and Nguyen in the AJ Economic Policy. They seem to suggest that small business lending is kind of a little bit of a sideshow when it comes to small business activity. It just doesn't seem to affect employment by small business that much. Conclusion, this paper made me think. I completely believe the correlations. I'm still confused about whether there's a causal relationship here or not. Thank you.